In Module 4.2, we're going to begin to explore the valuation of corporate bonds. And I just want to remind you that the objective here is to, again, equip you as a quantitative financial analyst to be able to create and innovate and come up with your own solutions to a variety of different financial challenges. Corporate bonds is one interesting area to apply your trade. Corporate bonds, as opposed to U.S. Treasuries, have some additional risk. They have default risk. Typically, this is measured by a credit spread. They have liquidity risk. When a bond is first issued, often it enjoys some liquidity, but then over time, that liquidity goes away. There's always embedded optionality. Many bonds are callable. Every bond is defaultable, even U.S. Treasuries, and the bonds might be convertible. We're not going to dive into this embedded optionality. What we're going to do here is basically model the credit spread as an additional LSC curve. And so the goal is to take a complex book of corporate bonds and be able to reduce at least the credit spread risk and the base curve risk to just a handful of parameters. So if we use a two-factor LSC model for both the base curve and the credit spread, then I can value different debt instruments with only 4 factors and explore the risk of my corporate bond portfolio. Again, the notation like before, we have some annual dollar coupon amount. We have the number of coupons per year. Par is the notional amount or notional principal. The lowercase f is the fraction of the payment period elapsed since the last coupon. That is measured in a number of accrued days since the last coupon payment up to the settlement date, divided by the number of total days within this period, typically semi-annual. Capital N is the number of remaining cash flows, and CFI is the ith cash flow, typically just the coupon amount if it's not the last cash flow, or the coupon amount per period plus the par value. We could explore yields in 2 different ways: discrete compounding and continuous compounding. The bond value based on discrete compounding and continuous compounding can be represented in this form. Remember, the quoted price of the bond doesn't change. The way you compound interest will cause changes in the reported yield to maturities. I have found in different analytic work, it's easier to deal with continuous compounding than it is discrete. You can always report final answers based on discrete compounding, but you can do your analysis with continuous compounding. It's just worth knowing there's different ways to express the yield. Remember, with discrete compounding, we basically have a polynomial. We have the yield, the annualized yield divided by the number of coupon payments. It's discounted by just a counter that runs across all the coupon payments, and we subtract off the fraction of the period that has elapsed already. In simple compressed notation, we can express it this way. With continuous compounding, it's simply e to the minus yc times the fraction of the period that has elapsed. It's important to note that these yields at the moment are assumed to be constant across the entire curve. And so rather than being a different discount rate for each cash flow, we'll explore that further as we get into the LSC model application. So the central finance concepts that we're going to look at, we're going to start out by exploring what is now the obsolete 3-month LIBOR versus 3-month CMT. We're going to explore a variety of different spreads. The term spread just refers to the additional yield that is offered based on the longer time to maturity. Could be negative. And then the different credit spreads based on the credit rating, and we'll explore some bond yield implications. When we begin to examine corporate bonds, it's important to step back and think about U.S. Treasuries. They are exempt from state and local taxes. That makes the yield artificially low as far as a proxy for the nominal rate. There's a high demand at times from the repo market, again, raising the price of the U.S. Treasury, lowering the yield. U.S. Treasuries enjoy a high level of liquidity. There's a flight to quality when there's global stress in the marketplace. If a war breaks out or there's some pandemic, perhaps, investors tend to sell risky assets and buy U.S. Treasuries, again, causing an artificially low interest rate. Interestingly, holding period returns are negatively correlated with equities, and the U.S. Treasury can simply print money, which gives them just a significant advantage. Banks, there's unique benefits to banks for owning treasuries. There's something called municipal bond advance refunding. It's beyond the scope of what we're doing here, but again, it creates an artificial demand for treasuries, driving the price up, lowering the yield. Thus, many decades ago, when the London interbank offered rate came about, it was actually the much preferred base curve rate because it was a good proxy for the marginal dealer's cost of funds. It didn't suffer from all these artificial influences upon treasuries. Unfortunately, LIBOR has now obsolete, and we're sort of in this time of uncertainty. Most likely the secured overnight financing rate will take its place, but there's other possible candidate replacements. And one thing I've learned about financial markets is you're just never quite sure how they're going to develop. So we're going to look at selected empirical observations just to increase our familiarity with the corporate bond market primarily. But first we'll look at U.S. Treasuries versus LIBOR in history. The interest rate swaps were a good proxy for term spreads. It's a collateralized AA rated instrument, primarily bank credit. The longer the time to maturity, typically you have higher spreads, and the more credit risky, you have higher spreads. So let's take a look at some empirical observations. 3-month LIBOR versus CMT. The bottom curve is the constant maturity 3-month rate. The blue curve is the 3-month LIBOR rate. And what you'll notice is that the AA credit LIBOR rate tends to exceed the 3-month U.S. Treasury rate. And that makes sense because, again, Treasuries have some artificial advantages driving their interest rate low, and the LIBOR rate is the AA credit, causing it to go up. During the great financial crisis in 08-09, there were some disruptions between the two, flight to quality to treasuries, an abandonment of LIBOR to some degree. And unfortunately, the people who were reporting LIBOR committed a variety of fraudulent acts, and that caused the LIBOR market regulators to want to put it out of existence. So the term spread, if you take the 5-year interest rate swap yield minus the 3-month LIBOR rate, and these swaps were tied to LIBOR, what you'll notice is almost the vast majority of the time, this term spread is positive, but not always. Sometimes it's negative. But typically investors are offered a higher yield for a longer time to maturity. That was not true historically before the United States went off the gold standard, just as a sidebar. And so the investment grade, the AA rated yield minus the 5-year interest rate swap. So if you look at corporate AAs versus the 5-year swap rate, what we observe is a positive spread over. Typically swaps are cross-collateralized, and so there's not a credit risk concern there. Corporate bonds do have higher credit risk, and so there's an offer of a higher yield for investment grade bonds. By investment grade, that's simply the AAA is the best rating down to a single B. But a double A rated is an investment grade spread, and we notice that this difference is positive. So the lower the rating, the higher the spread. We would expect the double A rate. We're going to look at a bond fund and compare a double A rated bond fund to a double B rated bond fund. And so the double B yield versus a double A yield, what we notice is this is a speculative grade bond. And so what we notice is that this is much higher than the double A rated, and it's always positive, at least over this time frame, and you'd expect it to be as it contains more credit risk. Looking at the corporate bond yields across the whole range of possible different credit ratings, what we observe is an amazing level of rationality within the marketplace, as these are fairly consistently ranked ordered. As we get as the credit rating deteriorates, the credit spread increases. And so that does not necessarily mean that you get a higher holding period return. In an analysis of the credit spreads, we're going to, when thinking about credit spreads, we have the expected loss given default, and we have the likelihood of default. And there's also the additional risk premium for bearing default risk. It's important to disentangle these issues. Clearly, a double B rated bond has a higher likelihood of default than a double A rated bond. However, different industries have different expected losses given that a default occurs. A software company whose primary asset is software developers, when they default, typically there's just not a whole lot left. When a financial institution defaults, trust is breached, and again, there's not much left to collect. If an industrial company with a lot of raw materials and industrial plant facilities default, it's very possible that the expected loss is not that great. What investors are interested in is, can I earn an additional risk premium for bearing this default risk above and beyond the expected loss given default and the likelihood of default? And so it's important to note that the holding period return does not equal to the yield to maturity, even if you hold it to maturity. One reason for that is the bond may default. And so you're offered a yield to maturity of 10%. You buy that bond and then it subsequently defaults, and you have a loss of 100% if the expected loss given default, or if the actual loss given default is 0. And so we're going to begin to dive into, we want to now begin to compare a double A rated bond fund versus a double B rated bond fund. And we'll pick this up in the next part.